And when I left and went off to Silicon Valley Bank to be their CFO of their largest division, about $2 billion worth of capital I managed. I wasn't even 30 years old. So it's a lot of responsibility for a young guy. Kind of found my way through. And when I was in venture capital, I learned who these people were. Who were the venture capitalists? What did they do? How did they get there? And then I watched the model go through from start to finish and got to meet a lot of entrepreneurs and see businesses formed, and also had the pleasure for them to write checks back to the investors who then took that money and started the cycle over again. So what I want to do today is to start out first and talk about who venture capitalists are. Okay? And so I know some of you out there might decide you want to be venture capitalists. So I want to explain sort of the prototypical blueprint to be a venture capitalist. First of all, I am not a venture capitalist. I was on the finance side. I did manage some investments, but I certainly would not call myself a venture capitalist. I had a vote at SVB for funding investments, but certainly it was not my primary responsibility. The managing directors made the final calls. I just provided some feedback on what I thought was happening in the company before we decided to fund it. So up here in Silicon Valley, Menlo Park is the headquarters for venture capital. I would say it's the global headquarters. So most of all the venture firms that you guys have heard about, that you've read about, that have funded companies like Google and Yahoo and eBay, are sitting up on Sand Hill Road in Menlo Park. So if you go up 280 North, you get off at Sand Hill, you start heading down towards Stanford. Right there on that road is where most of the venture firms are. And it is the second most expensive commercial real estate in the country, behind Manhattan in New York. So because of the close proximity where all the venture capitalists gather, it gives a very central location for entrepreneurs to come to try to get their deals or their companies funded. So there are the two types of venture capital I'm going to talk about today are what are called early stage and late stage venture capitalists. So I have worked primarily in early stage, although a couple of my clients are late stage venture capital firms. Early stage venture capital firms come in the ground floor. I've seen it from literally the venture firms funding people. So it's a few people that have an idea, they don't have a patent, they don't have a prototype, nothing. But they have relationships with these venture capitalists from years in the past. They trust them, they have confidence in them, and they basically will write them checks in the millions of dollars just to flesh out an idea. So the prototypical early stage venture capitalist who's getting involved at the ground floor has to have a skill set for evaluating deals. Okay, so in this area, what we see mostly are tech deals and life science deals. So if you are a venture capitalist that specializes in technology, you probably and very likely have an engineering background. As a software engineer, as a hardware engineer. And so with that engineering degree, most of the venture capitalists went off and worked in either small companies that became big companies, or a lot of the people that I have seen did big things at big companies. So spent time at Cisco, at Sun, at Oracle, okay? And they went through and they really helped develop products and grow businesses. And during that time, some point in their career, they may have left either temporarily or permanently to go pursue an MBA. And up here on Sand Hill Road, what I have seen, and I've probably met hundreds of venture capitalists, the MBAs that they're getting are from Stanford or Harvard, and that's it. Okay? If you get an MBA from UCLA, you're slumming it. Okay? They don't want to bother with you. So most of these individuals are very bright. I don't really see a whole lot of concern about where the undergraduate degree was, but certainly the work experience is critical, and where they study business at Harvard or Stanford, sometimes Wharton, for their MBAs. Okay, now during that time, oftentimes these venture capitalists have made some money through stock options, so they have some personal wealth amassed, and they've got to go out and try to either join up with an existing venture capital firm where they need a new partner, maybe with some new experience and skill sets, or they maybe pull together some other folks who have similar backgrounds and start a venture capital fund. So the key there is, if most of you are studying business and you want to be an early stage venture capitalist, you need to get out, okay, and go get a degree in engineering if you want to be an early stage venture capitalist, because at that point the VCs are taking what we call technology risk. So if they're going to give money to a very young company that hasn't had a lot of sales, maybe hasn't had a product developed, they need to feel very confident they can evaluate the technology. And the only way they can do that is if they have an education and some work experience in that area. Okay, if you want to work for a life science firm, a lot of those people have backgrounds in science and in medicine. So I've seen a lot of partners in that field that have MDs, medical doctor degrees. Some of them have undergraduate degrees in biology or chemistry. And then again, they go off and spend some time in the field working in maybe in a pharmaceutical company, or they spend time doing research in other areas. And then they come back and again, will likely go get an MBA from one of those top schools to learn how to apply their knowledge of science to the business field. Okay, so I know I just discouraged, no one's going to be a venture capitalist now, I ruined your life, okay? But let me tell you that the late stage venture capital platform is something that all of you could address. Okay, at that point, there's a whole market where venture capitalists come in at the later stage. So this is after the company's got a lot of revenue traction, they've grown into markets, they're on their way to becoming a public company, or they're going to be acquired by a public company. And at that point, the venture capitalist is taking execution financial risk. Okay, so you don't need to substantiate the technology or the science that's already been done. It's gotten to a point where there have been sales and FDA approval, and we're ready to go. It's now a matter of, can you get it enough runway, help the company execute on its operational goals, grow revenues, grow the business platform and the value proposition. That is something that business people can evaluate. So a lot of you guys that might want to become venture capitalists, you'd be looking more towards the late stage. At that point, you have an undergraduate degree in anything, you've got an MBA, and at that point you can relax a little bit. It doesn't have to be from Stanford or Harvard, but certainly from, I would say, a top 10, top 15 graduate school. You've done some work in the investment field, okay, as a financial analyst in a big company, or maybe you've worked for an investment bank doing some valuation work. And at that point, you would take financial risk. So you run financial models to figure out where their revenue multiples are supposed to be, what the company's worth, how much cash they need, and what valuation. And you are still a venture capitalist. You're still taking risk. You're taking a lot less risk, and therefore the multiples of earnings are a lot lower. So late stage venture capitalists don't make as much on their money as early stage do. Having said that, they have a lot fewer losers because the early stage people are taking risk on technology or on other, not on execution, but based on product specifications, and that can cause a lot more failures. So again, most of the time I've spent has been with early stage venture capitalists, although I did spend some time with a couple later stage. And there is an in-between market, but the in-between markets are really hard sell. Really hard sell. So you don't really have a lot of technology experience or product knowledge. You're not maybe an expert in modeling, and sometimes the middle of the road people, okay, end up taking the biggest hits from what I've seen, where you're writing a lot of checks, trying to bridge it to the late stage people. You're still taking some risk, and those people I have found can have a lot of problems. So where the venture capitalists have responded, this is not a class about this, but is to utilize venture debt. So there are firms out there that will provide debt financing to companies, early stage companies, to get them to a later stage. And I've worked for those companies too. So one thing Kenny didn't mention is every summer I spend time, since I got into higher education 6 years ago, consulting for venture capital and venture debt firms. This summer, I had a meeting yesterday with a client that I'll have all summer, InterWest Partners. They have a tech and a life science practice, and their controller is going on maternity leave, so I'll go in there and fill in for the summer, take care of her job, and then come back and teach here in the fall. It can be a very lucrative position because venture capitalists have very deep pockets, and so it's nice for me, and I get to keep my network current and my skills current in the industry. So if you go to a VC firm, and I'm going to talk about early stage, you got a lot of smart people with a lot of experience in technology and life sciences. They've developed products and services themselves, and now they're trying